Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It has been a huge week. We need to do one more episode before we move into what will no doubt also be an incredibly busy and consequential week. We have a lot to cover. Let's jump in. In North America, Wall Street kept a volatile week with a strong late-session rally on Friday, as assurances from the Federal Reserve helped calm frayed investor nerves amid the escalating trade conflict between the United States and China. The S&P 500 closed up 1.8%, bringing its weekly gain to 5.7%, its best performance since November 2023, despite still being down 4.4% for the month. The technology-heavy Nasdaq added 2.1%. The sharp rebound followed remarks from Susan Collins, president of the Federal Reserve Bank of Boston, who told the UK-based Financial Times that the Fed would, quote, be absolutely prepared, end quote, to act if financial conditions became disorderly. Her comments offered some relief to investors rattled by trade tensions and inflation concerns. While equities bounced back, other markets remained unsettled. The US dollar slumped nearly 1% against a basket of peers, hitting its lowest point since April 2022 before recovering slightly. Meanwhile, US government bonds seesawed throughout the day. The 10-year Treasury yield, a benchmark for global borrowing costs, rose 0.07 percentage points to 4.47, having earlier surged as high as 4.54% amid a morning sell-off. The backdrop to this volatility is a renewed tariff war triggered by US President Donald Trump, whose administration this week finalized 145% tariffs on Chinese imports. In retaliation, Beijing raised duties on US goods to 125% on Friday and declared it would ignore any further increases, citing, quote, the complete collapse of demand for American exports. End quote. The economic fallout is already evident. Consumer sentiment in the US dropped for a fourth straight month in April, with the University of Michigan's index falling to 50.8, far below expectations. Inflation expectations for the year ahead soared to 6.7%, the highest since 1981, underscoring the anxiety permeating households and businesses alike. Retailers warned of rising prices even as official data showed inflation cooled in March. In global markets, European stocks were mixed, with the Stoxx 600 edging down 0.1% and the FTSE 100 gaining 0.6%. Meanwhile, gold surged to another record high as investors fled to traditional safe havens. For Wall Street banks, however, market volatility has proven a boon. JP Morgan reported a better-than-expected 9% rise in quarterly net income to $14.6 billion. Morgan Stanley's earnings jumped 26%, driven by strength in its equities trading business. But investment banking divisions have struggled as uncertainty delays deal-making. Quote, market volatility is good for sales and trading, but it's bad for investment banking, end quote, one analyst noted. Despite the profits, financial leaders voiced concern. JP Morgan CEO Jamie Dimon warned of, quote, considerable turbulence, end quote, and urged caution. Wells Fargo's head echoed the sentiment, citing risks from President Trump's protectionist stance. The US Treasury market, long considered a safe haven, is no longer behaving as one. As former Treasury Secretary Larry Summers put it, long-term treasuries are starting to trade more like emerging market debt, raising fresh questions about America's financial stability. While more than 15 countries reportedly engaged in trade talks with the White House, bringing trade offers, the administration remains hopeful for good deals within Trump's self-imposed 90-day pause on additional tariffs. Yet with inflation rising, consumer confidence crumbling, and markets lurching, the question remains, can the US economy weather the storm? We will be following this very question and the story day by day here on Market Update. If you'd like to come along for the ride as we live history, consider subscribing to Market Update so you're on top of all these developments as they happen day by day. And if you're getting some value from today's episode of Market Update, don't forget to hit that like button. It's a tremendous help. Thank you so much. Next up, we move to Asia. China's decision to tighten export restrictions on 7 types of rare earths and permanent magnets has jolted global supply chains, but it's been a boon for a handful of Australian miners. Shares in Lynas Rare Earths, Northern Minerals and Arafura Rare Earth jumped last week, defying a broader market sell-off as investors bet on their growing strategic importance in an increasingly fractured global economy. The new Chinese controls target critical materials used in defense, robotics and renewable energy. While domestic Chinese industries remain well supplied, the move is likely to constrain global manufacturers, particularly those in the US and allied countries. Quote, if the US wants high-end permanent magnets, the factories need to be in China, end quote, noted a report by Ord Minnett, adding that defense companies may need to forget about access to key inputs. With around 60% of global rare earth output and nearly 90% of processing dominated by China, alternative suppliers are urgently needed. Australia, home to some of the world's richest high-grade deposits, is emerging as a leading contender. Lynas, backed by Japanese investors, is expanding its refining operations in Malaysia and constructing a facility in Texas with US Defense Department support. Northern Minerals and Aluka Resources are also pushing forward with development of heavy rare earth projects. The Australian government has pledged $1.6 billion Australian dollars to support domestic refining and announced plans to establish a critical minerals reserve in response to recent US tariffs. But experts warn that more is needed to reduce the world's over-reliance on China. Quote, governments must build not just mines, but full supply chains, end quote, said Gavin Mudd of the British Geological Survey. In a rapidly changing geopolitical landscape, Australia's rare earth sector is now seen as a strategic asset, one poised for significant long-term growth. Meanwhile, Thailand's tourism sector faces fresh challenges as concerns over safety following a powerful earthquake in neighbouring Myanmar have spooked international travellers ahead of the peak Songkran holiday. The 7.7 magnitude quake, which caused the collapse of a 30-storey building in Bangkok, has raised fears about infrastructure safety, prompting hotel cancellations and threatening the government's goal of returning to pre-COVID visitor levels. Songkran, the Thai New Year celebrated with water fights and nationwide festivals, typically draws millions of foreign tourists. Indeed, the footage you are seeing is from my holiday to the northern Thai city of Chiang Mai during last year's Songkran festival. It was wild and very busy. This year, though, hotel bookings have slumped, with over 1,100 room cancellations in just 2 days, according to the Thai Hotels Association president, who warned that foreign arrivals may fall short of the 39 million target, possibly remaining around last year's level of 35 million. Economic forecasts reflect the downturn. TTB Analytics projects a 13.5% decline in Songkran holiday spending, while SCB EIC anticipates up to 700,000 fewer foreign tourists in 2025 due to safety concerns. In response, Prime Minister Shinawatra has ordered a swift cleanup of the collapsed building site and called for enhanced tourism promotion. And finally for today, the European Union is preparing to unleash its most potent trade tools, including possible levies on major US technology firms, if negotiations with Washington fail to resolve a deepening tariff dispute. European Commission President Ursula von der Leyen, in an interview on Thursday, told the UK-based Financial Times that Brussels is ready to escalate the trade war into the services sector should President Donald Trump's 90-day pause on new tariffs not lead to a, quote, completely balanced agreement, end quote. Quote, we are developing retaliatory measures, end quote, von der Leyen said, referring to a potential expansion of EU trade responses to include the services sector. One option under active consideration is a single market-wide levy on advertising revenue of digital platforms, a move that would hit companies such as Google, Meta, and Facebook. This would be separate from national digital services taxes already introduced by some EU member states. Brussels is also considering invoking the EU's new anti-coercion instrument, which empowers the bloc to retaliate against economic pressure by targeting sectors such as digital trade and services. Quote, there's a wide range of countermeasures in case the negotiations are not satisfactory, end quote, von der Leyen warned. However, the day after this interview, on Friday, Germany's finance minister warned, quote, in many areas of digital services, especially for the corporate sector, unfortunately, there simply are not sufficient alternatives to the offering by the American digital industry. There are products where the ability to substitute for other services and other goods from other regions of the world is easy, and there are sectors where it is more difficult, end quote. Adding, quote, we have to be nuanced and differentiated, end quote. The Commission recently paused planned retaliation worth 21 billion euros, tariffs on US goods like poultry, orange juice and yachts, in hopes of progress during the talks. However, von der Leyen made clear that these measures would be immediately reactivated if discussions break down. Additional steps could include restrictions on scrap metal exports and measures targeting the large US services surplus with the EU. Von der Leyen rejected US calls to negotiate on issues like VAT, value-added tax, and digital market rules, labelling them as matters of EU sovereignty. Quote, "These are not in the packages of negotiation," end quote, she said. However, she expressed openness to discussing alignment of regulatory standards where feasible, though she cautioned that cultural differences often limit harmonisation. To protect the European market, the EU is implementing safeguards against redirected Chinese exports that might attempt to bypass US tariffs. Von der Leyen said she had raised the issue in a call with Chinese Premier Li Qiang, who assured her that Beijing would boost domestic consumption to offset export pressures. As we've discussed on my other channel, China Update, this is easier said than done. Regardless of the outcome with Washington, von der Leyen stressed that Trump's tariffs have permanently altered global trade dynamics. Quote, "We will never go back to the status quo," end quote, she said, noting that the disruption has accelerated EU efforts to deepen ties with other partners, including Malaysia, Thailand, the Philippines, Indonesia, and the United Arab Emirates. However, frankly, there is no market or markets in the world that can substitute for the size, depth, and dynamism of the US consumer market. Both the EU and US acknowledge the need to reform the WTO, World Trade Organization too, particularly in light of what they say are China's market-distorting subsidies. Von der Leyen expressed, quote, "We must modernize and stabilize the WTO. The goal isn't to preserve what we have, but to make it work for today's challenges. Never waste a good crisis." End quote. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Sunday, have a restful weekend, and I will see you for a new week, what will likely be a big week of updates, tomorrow on Monday. As concerns over safety following a powerful earthquake in neighbouring Myanmar. Why am I having trouble? Myanmar. In neighbouring Myanmar. Oh my god. Come on. Myanmar.